Understanding junior equity, what you need to know. Introduction to junior equity. Junior equity refers to stock issued by a company that stands at the bottom of the priority hierarchy concerning ownership rights. Known for its subordinate status, junior equity holders are last to receive financial payouts, such as dividends or compensation during bankruptcy proceedings. A primary example of junior equity is common stock, which is subordinate to preferred stock. This article delves into the workings, advantages, and considerations surrounding junior equity. Key characteristics of junior equity. 1. Common stock, the face of junior equity. Common stock is a prominent type of junior equity, representing ownership in a company. Unlike preferred stockholders who have a fixed dividend to receive, common stock dividends are less predictable and depend on the company's performance and board decisions. This potential for variable dividends adds a layer of risk and reward for investors. 2. Bankruptcy and priority structure. In the unfortunate event of a company filing for bankruptcy, junior equity holders are last in line to be compensated. The absolute priority rule governs the payout structure during a liquidation process, stipulating that senior debt holders, like bondholders, are paid first. Preferred stockholders come next, receiving their agreed-upon dividends. Finally, if there are any remaining assets, common stockholders share whatever is left, which is often minimal or non-existent. This order highlights the risks associated with junior equity investments. 3. Advantages of junior equity. Despite the risks, junior equity offers several advantages. Potential for higher returns. Historically, common stocks have provided greater capital appreciation compared to bonds and preferred shares. In a thriving economic scenario, they can lead to significant growth in value. Voting rights. Holding common stock often grants shareholders voting rights that allow them to influence company decisions, from electing the board to voting on major corporate actions. 4. Real-world example. To illustrate how junior equity functions, consider the fictional company, Larry's Lemonade. If the company issues bonds to finance its operations and subsequently faces bankruptcy, the liquidation of its assets will prioritize the following. 1. Bondholders, the first recipients of any available funds. 2. Debt holders, employees and suppliers who are owed money next. 3. Preferred shareholders, receive fixed dividends according to agreements. 4. Common shareholders, only receive payment after all debts have been settled. Given the scenario, common shareholders are likely to emerge with nothing or very little in return. Comparisons, junior versus senior equity. Senior equity. The opposite of junior equity is senior equity or senior securities, which stand higher in the repayment hierarchy. Senior equity holders are promised payments ahead of junior equity holders, significantly reducing their risk. Junior debt. A comparable concept in the debt market is junior debt, also known as subordinated debt. Juniper debt places investors in the same lower priority position for repayment, typically yielding higher interest rates due to the elevated risk involved. Special considerations for investors. Investors must weigh the trade-offs associated with junior equity. While it offers potential for impressive returns, the risks are equally significant. Essential considerations include market trends. Common stock performance fluctuates with market conditions, making it imperative for investors to monitor economic indicators. Company fundamentals. Assessing a company's financial health and management effectiveness is crucial before investing in its junior equity. Conclusion. In summary, junior equity, particularly through common stock, represents a unique investment opportunity characterized by high risk and potential high reward. Understanding its inherent structure, advantages, and the implications of bankruptcy is vital for potential investors. By carefully evaluating these factors, investors can make informed decisions that align with their financial goals and risk tolerance.